Hey there, learners. Ever felt like the world of crypto is just this swirling vortex of hype, jargon, and a million charts to make your head spin?
Oh, yeah. You're definitely not alone there.
Well, today we're cutting through all that noise. We want to get to the very DNA of cryptocurrency value.
We're doing a deep dive into tokenomics.
Exactly. Tokenomics kind of the secret sauce that can help you understand why some digital assets thrive, while others just fade away.
Mm-hmm.
Our mission today is really to equip you with the tools, the precise tools to analyze tokens, understand their underlying economic design.
And figure out what really makes them tick for long-term potential.
Right. No more guessing games.
Yeah.
Just solid, actionable insights so you can make informed decisions.
And what's really fascinating here is that unlike traditional investments, stocks with clear revenue streams, crypto valuation demands understanding these unique economic mechanisms.
Well, it's different.
Completely. Think of tokenomics as like the monetary policy for a digital economy. It dictates how a token is created, distributed, and used within its ecosystem.
And that fundamentally shapes its value.
Absolutely.
So it's about getting past the headlines, beyond the daily price swings, and really understanding the true purpose, the functionality, and the strategic design that underpins a token's long-term viability.
That's the core of it.
Okay, so let's unpack this then. If you're looking to invest, or maybe just understand a cryptocurrency better, what are the fundamental measures? What criteria do you need to examine?
Where do you even begin, right? Especially if you're thinking long-term, like a 5-10-year hold.
Yeah, exactly. Where do you start?
That's a really important question because a thorough analysis goes, well, far beyond just looking at price charts or social media buzz.
Right.
We need to look at several key pillars.
Okay, pillars. What's the first one?
First up is foundational research. And this really starts with the white paper.
The infamous white paper.
Yeah, it's the project's blueprint. It outlines the philosophy, the technology, the core mechanics.
But reading it isn't just a quick skim, is it?
Oh, definitely not. The real insight you get from a robust white paper isn't just what they plan to do,
Okay.
but how they demonstrate a deep understanding of economic incentives. And crucially, whether they present a novel solution that genuinely requires their token.
Ah. So is it a must-have or just a nice-to-have?
Precisely. That's a key distinction. It demands careful examination, not just a glance.
Okay, so the white paper sets the stage. What about the people behind it? How much weight should you give the team's public profile?
The development team is crucial. You're looking for accountability. Public founders, like, the ones behind Ethereum, Solana, or Uniswap.
The ding names.
Right. They've shown high levels of success, talent retention, even during what we call a crypto winter.
That's that period of prolonged market decline and pessimism.
Exactly. Surviving that shows resilience. However, be aware. Public credibility can also be used to market, let's say, centralized platforms that might have underlying issues.
So it's not foolproof.
Not at all. Anonymous developers combined with really aggressive marketing but no verifiable tech docs. That's usually a red flag.
Got it. Red flag. And what about the community?
Community engagement, that's the next piece. A vibrant, engaged community is honestly a vital sign of a project's health.
How do you gauge that?
You explore the forums, social media, get a feel for the sentiment, the perceived value. It's like a living, breathing indicator of belief in the project.
Okay, so white paper, team, community. That's the foundation. But in crypto, the supply of these assets feels incredibly different from traditional finance. Is that right?
Absolutely. And that leads us straight to the second pillar, supply dynamics. This is so crucial for understanding a token's intrinsic value.
Okay, supply dynamics. Break that down.
You need to understand scarcity and the emission rate. This means looking at the circulating supply the token's actively traded right now.
Okay.
Then the maximum supply, the highest number the project ever intends to create.
Like Bitcoin's 21 million.
Exactly. And the total supply, everything created so far, the token emission rate, meaning how quickly new coins are released, that significantly impacts value.
How so?
Well, Bitcoin's fixed limit and its decreasing emission schedule, the halving events, that's programmed scarcity. It's designed to drive long-term value.
Makes sense. Less supply, potentially more value.
Right. Projects with an unlimited supply, they often struggle with inflation, which erodes value over time.
Okay. What else under supply?
Next, consider the distribution methods. How did the tokens get out there initially?
Like mining, staking.
Yeah, mining, staking, airdrops, initial coin offerings, ICOs, where projects raise capital selling new tokens. All these affect market stability.
Wow.
Well, a wider, fairer distribution is generally better. Think of convex finance. They allocated the vast majority of their supply to users, not a small team. That reduces the risk of market manipulation of just a few people holding all the power.
Concentrated ownership is risky.
Very. And importantly, look for deflationary mechanisms.
Mechanisms that reduce supply.
Exactly. Things like token burns or recycling. Binance Coin, BNB, is a good example. It's deflationary because they do quarterly token burns.
Burning tokens,
Yeah.
they just destroy them.
Effectively remove them from circulation, yes. Their goal is to remove 50% of the total supply over time. It tightens supply.
Wow. Okay, so it's not just how many tokens exist, but how they appear, how they're spread out, even how they disappear.
Precisely.
Which brings us to maybe the most crucial question.
Yeah.
What does the token actually do? Is it just a collectible, or does it have a real job?
Yes. The third pillar, utility and use case. You absolutely have to ask the why.
The why.
Does the token have real-world utility that directly impacts its long-term value and demand? Does it solve a necessary, a valuable problem?
And that earlier point, could its function be done without the token?
Critically important. If a token is just nice to have rather than must have for its project, that's a significant concern for long-term viability, especially that 5-10-year horizon.
Can you give some clear examples of must-have?
Sure. ETH is maybe the quintessential example. It's essential for transaction fees, smart contract payments, staking on the Ethereum network. You can't use Ethereum without ETH.
Okay.
BNB, used for discounted trading fees and gas on the Binance Smart Chain. Uniswap's UNI token, used for governance, voting on the biggest decentralized exchange, or DEX.
So these tokens have jobs built into their ecosystems.
Deeply embedded intrinsic utility, yes.
Yeah, that distinction, nice to have versus must have, feels absolutely key, like the difference between a decoration and a tool.
Exactly.
But let's be honest, for many people listening, the ultimate why behind investing is, well, making money.
Yeah.
How does tokenomics address that beyond just hoping the price goes up?
Right, beyond speculation, which brings us nicely to the fourth pillar, return on investment, ROI, and game theory.
ROI and game theory, okay.
First, look at cash flow. Does holding the token actually generate income or cash flow for you?
How would it do that?
Things like staking rewards, where you earn more of the token just for holding and securing the network, like with Ethereum or Avalanche, or maybe a share of the protocol's revenues, like with SushiSwap or Curve Protocol.
So the token itself produces value.
Exactly. These are key indicators of a token's productive value. Without some kind of intrinsic ROI, the reason for holding can become purely speculative. That's a riskier bet long term.
Makes sense. What about the game theory part? Sounds complex.
It's about incentive structures. Game theory just analyzes strategic interactions and formalizes these incentives. Good tokenomics create incentives that align users with the network's goals.
Like?
Curve Protocol is a great example. They offer greater rewards and lower fees the longer you lock up your CRV tokens.
Ah, so it encourages holding.
Dramatically reduces sell pressure, encourages long-term commitment. Convex Finance, we mentioned earlier, also uses strong game theory. They have 16-week lockups for rewards. Basically becomes a cash flow machine for those who commit.
A cash flow machine. That sounds like a very compelling reason to hold.
It can be.
But how secure is all this? The crypto space has, unfortunately, seen its share of hacks, vulnerabilities, spectacular failures.
Absolutely critical point, which
Okay.
is why the fifth pillar, security and decentralization, is paramount.
Okay, security. What do we look for?
You have to understand the network resilience. How does the consensus mechanism, whether it's proof of work like Bitcoin or proof of stake like newer Ethereum, how does it guard against attacks?
Like those 51% attacks I hear about.
Exactly, where one entity gets control of over half the network's computing power, or state tokens. Or Sybil attacks, where someone creates tons of fake identities to gain influence. How resistant is the network?
And there's that trade-off, right? The trilemma.
The blockchain trilemma, yes. Projects often have to optimize for 2 out of 3. Scalability, decentralization, and security. It's a fundamental trade-off.
How do you measure decentralization?
The Nakamoto coefficient is one way. It measures the minimum number of independent entities needed to compromise the system. Higher is generally better.
So more distributed control is safer.
Generally, yes. Centralization, like on the BNB chain with its 21 validators, can mean higher risks of collusion or censorship. They had that $100 million hack in October 2022.
Right, I remember that.
It was eventually halted because the validators coordinated, which is good in one way, but also shows how centralized coordination can override the network. It introduces single points of failure.
And what about the code itself? Smart contracts.
Smart contract vulnerabilities. Even meticulously audited code can have flaws. We see things like flash loan exploits,
What are those again?
where an attacker basically takes out and repays a huge uncollateralized loan within a single transaction, using it to manipulate market prices in between for profit, or even simple rounding errors. These can lead to significant losses. They aren't just theoretical risks, they happen.
That's a critical point. Even strong systems might have hidden weaknesses. So who actually makes the decisions in these supposedly decentralized systems? How much control do regular token holders really have?
Excellent question. That's the sixth pillar, governance.
Governance, how things get decided.
Right. Token governance dictates how decisions like protocol updates or how treasury funds are allocated are made. Governance tokens, like UNI for Uniswap or PocketFi's SWOT-CH, grant voting rights.
So token holders vote.
Ideally, the goal is decentralization versus control. Decentralized governance aims to reduce single points of failure, make the system more resilient.
But is it always truly decentralized?
Often not completely. Many DeFi protocols still have some level of centralization, maybe through concentrated ownership where a few wallets hold most of the tokens, or admin keys, special privileges held by the founding team, or just a very skewed distribution of governance tokens.
So the voting power isn't evenly spread.
Frequently not. Remember the Juno protocol? They had a community vote to actually confiscate tokens from a wallet suspected of a Sybil attack.
Wow, they took someone's tokens.
The community voted to, yes. It raised really critical questions about the credible neutrality of public blockchains. Can the ledger be rewritten by majority vote? It's a complex balance, and you need to understand where the real power lies in any given project.
Okay, so we've gone through foundational research, supply dynamics, utility, ROI and game theory, security and decentralization, and governance. It's a lot to consider.
It is.
So after weighing all these pillars, what does this all mean when you're trying to figure out if a token is a solid long-term bet? Especially for utility, maybe for that 5-10-year hold.
Yeah, connecting it all to the bigger picture, there's a saying in crypto, hype dies fast, fundamentals last.
I like that.
Successful investing, especially long-term, demands thorough research and due diligence. You need to focus on a project's genuine utility, its robust tokenomics, its long-term sustainability, not just fleeting price pumps.
So it's really about conviction investing, not just chasing green candles on a chart.
Exactly right. Patience, deep research, and frankly, a pretty high risk tolerance are crucial in this space. You need to understand market cycles, try to avoid FOMO, that fear of missing out.
Which is so hard sometimes.
It is. And also learn to identify FUD, fear, uncertainty, and doubt, which is often spread deliberately to manipulate market sentiment and drive prices down.
Okay, avoid FOMO, identify FUD. What are some of the biggest traps you need to watch out for in this space? Feels like there are quite a few.
Oh, there are. The industry is unfortunately rife with scams. You see pump and dump schemes all the time. Rug pull.
Rug pulls, where the
Wow.
founders just disappear with the money.
Exactly. They drain all the liquidity from the token, leaving investors holding worthless assets. The Froggy Coin incident was a classic example. You also see fake ICOs, sophisticated phishing attacks, even AI-generated deepfake videos of known figures endorsing scams.
Wow, deepfakes too, that's scary.
It is. And beyond outright scams, sometimes it's just flawed design. A critical example, a catastrophic one, was the Terra Lunis collapse back in May 2022.
I remember that shook the whole market.
It did. UST was an algorithmic stablecoin designed to hold its $1 peg without full collateral backing. It lost its peg. It triggered a death spiral. Its volatile counterpart token, Alunine, which was supposed to absorb the volatility, hyperinflated into worthlessness as people rushed to redeem USD. It wiped out billions. It starkly highlights the immense risks of uncollateralized stablecoins and, frankly, poorly designed tokenomics.
That's a powerful reminder that robust tokenomics aren't just about ensuring growth, they're about preventing catastrophic failure.
Couldn't have said it better myself. Prevention is key.
And what about the rules? Regulations seem like a moving target.
Indeed. The regulatory landscape is constantly evolving. You have international bodies like FATF, BCBS, CPMI, IOSCO setting guidelines
Global standards emerging.
slowly. And then regions like the EU are implementing specific frameworks like MiCA, the Markets and Crypto Assets Regulation. That provides clear rules for issuing tokens and stablecoins in Europe.
What about the U.S.?
In the U.S., it's still largely driven by the SEC applying the Howey test. That's the legal test from the 1940s used to determine if something is an investment contract and therefore a security.
Still applying old rules to new tech.
Pretty much. Recent court rulings, like the one involving Ripple Labs and XRP, are adding nuances. The judge made distinctions based on how the tokens were sold. Sales to institutions were deemed securities offerings, but programmatic sales on exchanges weren't.
So how it's marketed matters legally.
It seems so. If the marketing pitches speculative value propositions, it's more likely to be seen as a security, so you absolutely need to pay attention to how a project presents its token.
Okay, so with all these risks, scams, flawed designs, changing regulations, how can you, the learner, protect yourself practically?
Good security hygiene is just non-negotiable. Use strong encryption, unique, complex passwords for everything. Always enable two-factor authentication, 2FA.
And use an authenticator app, not just SMS, right?
Preferably, yes. Authenticator apps are more secure than SMS for 2FA. For any significant holdings, hardware wallets are crucial.
Cold storage, keeping keys offline.
Exactly. Multi-signature wallets, which require multiple keys to approve a transaction, add another layer of security. Be incredibly cautious of fake emails or websites trying to phish your details. And use a trusted VPN, especially on unsecured public Wi-Fi networks.
Basic digital security, but super important here.
Fundamental. Absolutely fundamental for safeguarding your assets.
Okay, looking ahead then. What are some of the big trends you see impacting tokenomics and long-term potential? What should we be watching?
Well, one huge trend is the tokenization of real-world assets, or RWAs.
RWAs, so bringing traditional assets onto the blockchain.
Exactly. We're talking about things like real estate, art, private equity, even traditional money market funds being represented as tokens on a blockchain.
Who's doing this?
Big players are getting involved. BlackRock partnered with Securitize to offer a tokenized money market fund. Robinhood is exploring tokenized private equity.
Wow, institutions are really moving in.
They are. Boston Consulting Group estimated that up to $16 trillion worth of RWAs could be tokenized by 2030.
16 trillion. Why? What are the benefits?
Things like instantaneous settlement, 247 markets, increased transparency, and crucially bringing liquidity to previously illiquid assets. Think trying to sell a fraction of a building versus selling a token representing that fraction.
Makes sense. Easier to trade.
Much easier. And related to this is the surge in institutional investment overall. We've got Bitcoin ETFs approved now in the US. A growing percentage of Bitcoin and Ethereum supplies being held by public companies. This influx of institutional capital could profoundly shift the demand and utility for certain tokens, especially those facilitating RWA tokenization or serving institutional needs.
Okay, that's a massive trend to watch. RWA tokenization.
Definitely.
So for you, our discerning listener, after this really deep dive into all the criteria of the market dynamics, what examples of utilitarian tokens, the ones with real jobs, truly stand out? Based on these tokenomics principles we've discussed, which ones look like they have robust design and genuine long-term potential?
Right. Let's look at some specific examples that showcase different facets of strong tokenomics. And remember, this isn't financial advice. Always do your own research.
Of course. Examples to illustrate the principles.
Okay, first, you have to mention Bitcoin, BTC. It's the quintessential example of scarcity-driven value.
The original.
The original. Its fixed supply, 21 million coins, and that continually decreasing emission rate through halvings creates inherent digital scarcity. That's the fundamental driver of its long-term store of value proposition. It's simple, transparent, incredibly robust supply dynamics.
Hard to argue with that model.
Then there's Ethereum, ETH. This demonstrates immense utility in evolving deflationary mechanics.
The backbone of DeFi and NFTs?
Exactly. It's the backbone of the largest smart contract ecosystem. Its intrinsic utility for gas fees, running smart contracts, staking, combined with the deflationary pressure from EIP 4559 burning fees, plus the move to proof of stake. It makes ETH a really robust asset. It's essentially a required commodity for using the decentralized web.
A must-have if there ever was one.
Definitely. Next, maybe Uniswap, UNI. This stands out for its governance power and potential future ROI.
The biggest DX.
Right. As the governance token for the most widely used decentralized exchange, UNI holders get to vote on critical protocol changes. It has strong brand recognition, massive usage, and there's this potential for future revenue sharing through activating a fee switch.
So holders might get a cut of trading fees.
That's the proposal being discussed. It makes its tokenomics really compelling by aligning incentives for long-term participation and value accrual.
Okay, governance and potential cash flow. What else?
How about Chainlink, Elena? This token is all about critical infrastructure utility.
The Oracle Network.
The Oracle King, exactly. Chainlink provides essential real-world data price feeds, weather data, whatever, to smart contracts. It links off-chain info to on-chain applications.
So smart contracts can react to the real world.
Precisely. Without reliable oracles like Chainlink, smart contracts are kind of stuck in their own little world. That makes LNK a foundational, almost indispensable piece of infrastructure for many Layer 1 blockchains and for enterprise adoption.
Infrastructure play. Got it.
Then let's revisit Convex Finance, CVX. We mentioned it for distribution, but it's also a masterclass in game theory and incentivized ROI.
The cash flow machine.
Right. Its tokenomics are specifically designed to incentivize long-term holding. You get high ROI from protocol fees, but you have to lock up your tokens for 16 weeks.
That's a commitment.
It is. And it creates this really robust financial incentive system that dramatically reduces sell pressure and encourages deep user participation. It really demonstrates powerful economic design.
Interesting how game theory plays out.
Then you have something like AAVE. AAVE. This is a battle-tested example of core DeFi utility.
Lending and borrowing.
One of the leading decentralized lending and borrowing protocols. AAVE tokens grant governance rights, and they're also expected to benefit from fee-sharing upgrades soon. That ensures continued utility and value accrual for holders. Its long-standing presence and critical function highlight a robust, resilient design in the core of DeFi.
Proven track record matters.
It certainly helps build confidence, and maybe one more, looking towards that institutional RWA trend, Quant, QNT.
Quant. Tell me about that one.
Quant offers a unique value proposition focused on institutional adoption and interoperability. It has a relatively low maximum supply of only 14 million tokens, which creates scarcity. Its main product, Overledger, is designed to connect various blockchains and even traditional legacy systems.
So bridging the old and new worlds.
That's the goal. This positions it strongly for that growing trend of RWA tokenization and attracting institutional investment. It showcases a forward-looking utility.
Okay, so BTC for scarcity, ETH for utility deflation, UNI for governance potential ROI, Link for infrastructure, CVX for game theory ROI, AAVE for core DeFi utility, and QNT for interoperability institutions. That gives a good range of examples showing these principles in action.
Exactly. Different paths to potentially robust tokenomics.
So, wow, you've just received a masterclass in tokenomics. From deciphering those white papers and understanding supply dynamics to leveraging game theory and scrutinizing governance, we've really unpacked the crucial elements you need to evaluate a crypto project for its long-term potential.
Yeah, it's really about combining that technical understanding with strategic foresight, focusing on the real utility, the resilient economic design, not just getting caught up in the market noise.
Right. Thinking like an economist almost, not just a trader.
Remember, the crypto world tends to value fast learners who can also think long-term. This isn't just another asset class. For many involved, it's a mindset, maybe even a movement.
That ability to read the tokenomics from the white paper, understand the social consensus from the community, and the charts, that's your strength.
That will be your greatest strength in navigating this space effectively.
Absolutely. And, while we've given you a powerful framework today, it makes me wonder, as these digital economies mature, what new measures of value might emerge? Things we can't even conceive of yet.
That's a fascinating question.
Could it be that human behavior, decentralized coordination, maybe even, dare I say, societal impact, could that become the ultimate arbiter of a token's long-term success, rather than just pure code or market cap?
A provocative thought indeed. Where does value truly come from in these new systems?
Keep those questions in mind, keep digging, keep learning. This has been another deep dive just for you.
Thanks for tuning in.
We'll catch you next time.